video is on choosing between new tax regime and old tax regime. The video is divided in 3 parts. In the first part, we would be discussing the overview of the two schemes, the tax slabs applicable in the old as well as the new tax regime, and the benefits of opting in or opting out of the new tax regime. In the second video, we will be discussing the procedure for opting out of the new tax regime. And in the third part, we would be discussing the frequently asked questions on the new tax regime. This video covers part 1 of the series. New tax regime was introduced for individuals and HUFs in Budget 2020. Income tax slabs were altered and taxpayers were offered concessional tax rates in the new regime. However, the concessional tax rates were offered with a condition that several exemptions and deductions otherwise available in the old tax regime will not be available in the new regime. In Union Budget 2024 and 2025, the government focused on new tax regime, making it more attractive for the taxpayers. New tax regime was also made applicable to association of persons other than cooperative societies, body of individuals and artificial judicial person. In this video, the two regimes are compared for better decision making. Let us first check the tax slabs which are applicable in the old tax regime. Old tax regime refers to the system of income tax calculation and slabs that existed before the introduction of the new tax regime. In the old tax regime, individuals have the option to claim various deductions and exemptions to reduce their taxable income. This regime offers more than 70 deductions and exemptions. It may also be noted that the tax slabs also are divided into 3 parts. For individuals less than 60 years, association of persons, body of individuals and artificial judicial persons, the basic exemption limit is Rs 2,50,000. The second category is resident senior citizens between the age of 60 to 80 years where the basic exemption limit is Rs 3 lakhs. The third category are resident super senior citizens of age 80 years and above where the basic exemption limit is up to Rs 5 lakhs. Additionally, tax rebate up to Rs 12,500 is available for resident individuals less than 60 years of age and up to Rs 10,000 for resident senior citizens if the total income does not exceed Rs 5 lakhs. Let us now check the tax rates for individual, HUF, association of persons, body of individuals and artificial judicial persons in the new tax regime. For financial year 24-25 relevant to assessment year 25-26, there is no tax up to Rs 3 lakhs. From 3 lakhs to 7 lakhs, the rate of tax is 5%. From 7 lakhs to 10 lakhs, it is 10%. From 10 lakhs to 12 lakhs, 15%. From 12 lakhs to 15 lakhs, 20%. And above 15 lakh, 30%. Please note, tax rebate up to Rs 20,000 is applicable to resident individuals if the total income does not exceed Rs 7 lakh. Surcharge and cess will be applicable over and above the tax rates. The marginal relief on rebate is also available and the rebate is not available for income that is taxed at special rate, for example, capital gains under section 112A. For financial year 25-26 relevant to assessment year 26-27, there is no tax up to Rs 4 lakhs. From 4 lakhs to 8 lakhs, the rate of tax is 5%. From 8 lakhs to 12 lakhs, 10%. From 12 lakhs to 16 lakhs, it is 15%. From 16 lakhs to 20 lakhs, 20%. From 20 lakhs to 24 lakhs, 25%. And above Rs 24 lakhs, 30%. Please note, tax rebate up to Rs 60,000 is applicable to resident individuals if the total income does not exceed Rs 12 lakhs. Surcharge and cess will be applicable over and above the tax rates and the marginal relief on rebate is still applicable. Also, please note that the rebate under section 87A is not available for income that is taxed at special rates, for example, capital gains under section 112A. However, lower surcharge rate is applicable for high net worth individuals, HUFs, association of persons, body of individuals and artificial judicial persons in the new tax regime, where the surcharge rate on total income above Rs 5 crores has been reduced from 37% to 25%. Therefore, the highest effective tax rate has been reduced from 42.74% to 39% in the new tax regime. Also, please note that the maximum rate of surcharge on income by way of dividend or income under the provisions of Section 111A, 112A and 115AD is restricted to 15%. Also, in case of an association of persons consisting of only companies as its members, the rate of surcharge on the amount of income tax is maximum at the rate of 15%. With effect from financial year 23-24, that is assessment year 24-25, the default tax regime has been changed to new tax regime. So if you want to file your return under the old tax regime by claiming all the deductions, exemptions and losses, then you have to file it within the due date. After the due date, you have to mandatorily file under the new tax regime by giving up on most of the deductions and exemptions and all losses. Let us now compare the deductions under the old tax regime vis-a-vis new regime. Under the old tax regime, there are various deductions like standard deduction from salary of Rs 50,000, leave travel allowance, Section 80TTA and Section 80TTB deduction of professional tax under Section 16(3), house rent allowance, exemptions for free food and beverages through vouchers, food coupons, etc. under Section 17, subsection 2, clause 8, deductions up to Rs 1.5 lakhs under Chapter 6A of the Income Tax Act, deduction under Section 80CCD, subsection 2, deductions under Section 80CCD1B up to Rs 50,000, medical insurance premium under Section 80D, interest on home loan for self-occupied or vacant property, and set-off of losses under the head income from house property. However, if you compare it with the new tax regime, in the new tax regime, only standard deduction from salary is available along with deductions under Section 80CCD2 for employers' contribution to employees' NPS account. Along with this, under the new tax regime, there are some more exemptions and deductions which are available. That is transport allowance in case of a specially abled person, conveyance allowance received to meet conveyance expenditure incurred as a part of employment, any compensation received to meet the cost of travel on tour or transfer, daily allowance received to meet the ordinary regular charges or expenditure on account of absence from regular place of duty, perquisites for official purposes, exemption on voluntary retirement, Section 10, subsection 10C, gratuity under Section 10, subsection 10, and leave encashment under Section 10, subsection 10AA, interest on home loan on let-out property under Section 24, gifts up to Rs 50,000, deduction for employers' contribution to NPS account under Section 80CCD, subsection 2, deduction on additional employee cost under Section 80JJA, standard deduction of Rs 75,000 under the new tax regime is allowed against income under the head salary, deduction of family pension income under Section 57(2)(a). Further, Budget 2023 has also introduced a deduction of amount paid or deposited in the Agniveer Corpus Fund under Section 80CCH, subsection 2 under the new tax regime. As already discussed, from assessment year 24-25, the new tax regime has been set as the default regime. Therefore, if you wish to continue using the old tax regime, you must opt out of the new tax regime in your income tax return or file Form 10IEA at or before the time of filing your income tax return. Form 10IEA is applicable only if you are having business income. Non-business income taxpayers will have the option to switch between the two regimes on an annual basis at the time of filing their income tax return. So in brief, it can be said that the benefits or the disadvantages of opting for the new tax regime or the old tax regime are: in the new tax regime, you have the reduced rates of taxes, but you have the fewer deductions available. In the old tax regime, you have the benefit of more than 70 exemptions and deductions. However, the disadvantage is that you have higher tax rates. For choosing the tax regime which is most beneficial to you, you may use income tax calculator, which is available on income tax portal in the quick links section. This will help you in calculating tax liability as per new tax regime and old tax regime and to compare the two. Choosing between new tax regime and old tax regime is very easy. To know more, you can visit our website www.incometax.gov.in or contact our helpline numbers.